Hello, and welcome to OnPoint, a podcast by Oak Street Funding, where we sit down with industry leaders to bring insights to the topics you want to hear about. I'm your host, Matt Staninger, Market Research Analyst here at Oak Street Funding, and let's get on point. Today, I am joined by Marc Chandler, Managing Director and Chief Market Strategist at Bannockburn Capital Markets. And we are going to be giving an economic outlook following the most recent Fed meeting and jobs report data. We'll touch on inflation, the labor market, interest rates, and the biggest factors that could shape the economy throughout the rest of the year into 2027. Marc, thank you for joining me.
It's always a pleasure to see you, Matt.
Likewise. So let's jump into things. To start, we're just a little past the mid-year point. How would you describe the overall state of the US economy?
Well, it's interesting because we've really got conflicting data. And even though the GDP, the overall growth of the economy, looked like it slowed, I should say, in the last couple of quarters. When as economists, what we try to do is strip out the noise, and in this case, the noise what we want to strip out is see how strong the domestic economy is. So there's a measure called final sales to domestic parties. What this does is it excludes inventories, government spending, and trade. So we get a better picture of the domestic economy. And it really accelerated in the second half of this year. I should say in the second quarter, we grew on this measure of final sales to private domestic parties, grew by 1.9% in Q4 of last year, accelerated to 2.5% in Q1, and reached 3.4% on a preliminary basis in Q2. So this really shows that the economy is growing above trend, and trade inventories in the government net were negatives for the economy.
Great insights there. That's one of those reports that isn't talked about very much. We see a lot more noise now than what we had seen in a more stabilized history throughout the 20 teens, for instance. So, very good takeaway there. What's your overall headline takeaway from the latest monthly reports that maybe are a little more mainstream?
Sure. So we did see a loss of jobs in the July jobs report that we had a couple weeks ago. That was disappointing. The unemployment rate fell, kind of surprising, but we have to keep in mind that the job growth is really a function of a survey for establishments, for businesses. The unemployment rate is really a result of a survey of households. So they're two different like time series, if you will. And the unemployment rate fell primarily because participation rate, the number of people who are either in the labor market or looking for a job, that is, they have a job or are looking for a job, actually fell. And that's what brought the unemployment rate down. So we had these conflicting data again, loss of jobs, but a decline in the unemployment rate. At the same time, I should say, more frequent report weekly jobless claims. These are people who are filing for unemployment benefits for the first time. For the past 4 weeks, the average, and we used a 4-week average to just smooth out the noise with holidays and different things that could cause short-run disruptions. The 4-week moving average is below 200,000 for the first time in a generation. So this suggests to me that if people are getting laid off, they're getting hired pretty quickly. And so we are seeing these conflicting signs in the labor market, and I think that this partly is reflecting the sort of the unease of the overall economy, and that unease is really still that the activity is really being fueled by two things. One is the consumer, and the consumer is consuming, it's shopping. We're still shopping, and this is primarily coming not only from income from jobs, but also we're going into our savings. And the other main support for the economy is coming from one main sector, and that's the AI sector, which really involves technology, construction, and so there's a lot of feeding industries into the AI build out. And these, I think, are the two main engines right now of the U.S. economy.
Great insights there, Marc. How did this month's reports change your view of the 2026 economic outlook for the rest of the year, if at all?
Well, I'm not sure that's really changed my outlook very much. I do think though that we are going to have some challenges coming up, and we sort of know what they are. We just don't know the magnitude of them. And those challenges I think come in a couple different forms. One is of course whatever is going on in the Middle East. Many U.S. officials had been playing up the possibility that the Strait of Hormuz could be open soon, and the market is just not believing it anymore. And so we've got higher oil prices, and that still has to run through the economy. Oil has been volatile, means higher gasoline prices that I'll have to bear. In addition to that, we're seeing this weather pattern, El Nino, and it is really wreaking havoc to not only in the U.S. but Europe. There's reports that 25,000 people have died in Europe from this heat wave. And the heat wave is we're seeing this not only in Europe, but also in the US, South America, lower rivers. And this is really straining transportation. So not as many ships, lighter ships have to go through. And this means, I think, higher food prices. We had that shock from the Middle East war, where we had a disruption of pesticides and fertilizer earlier on in this agricultural cycle. And now, as farmers in the north begin their harvest, thinking about harvesting, we have this other shock coming from the weather and the drying up of shipments and low yields. And so I think that even though we might have gotten some relief from oil prices, not still high at $80 a barrel or so, well off the highs of say $95 to $100 a barrel, but we're not really seeing the relief in the grocery shops. And this, I think, is going to persist through most of the summer.
Right, we're seeing a lot of that inflation really remain sticky, economy really staying resilient to spending, as you had alluded to. Let's talk a little more directly with the Federal Reserve's direction then. We, of course, are seeing them have the markets take a little bit more of a lead. So we've seen more of 50-50 on the last couple meetings of whether we think there's going to be a rate change or not going into that meeting. They're showing a lot fewer of their cards prior to the meetings and prior to the press conferences. So, how do you feel these monthly reports that have come out since the last Federal Reserve meeting affects their decision making for the rest of 2026?
Sure, yes. And I think it's important to recognize that we've got a new chair at the Federal Reserve. We've had a period of great continuity at the Federal Reserve, from Bernanke through Yellen and then Powell. There's a great continuity. General approaches were the same. The philosophy seemed to be the same, and the reaction function, how they responded to economic data, seemed the same. Now, President Trump has appointed and nominated Kevin Warsh, to the helm of the Fed. He's been a long-term critic of the Federal Reserve, even though he was a member of it earlier on. As to your point, he does seem to be less forthcoming. He does not want to give much forward guidance, giving the market a greater sense of what the Federal Reserve is thinking about the economic data and what it will do. Still, we have the dozen regional presidents who are still free to talk, and they have been talking. And I think that in general, the market still anticipates at least one rate hike this year. You know, Chair Warsh has talked a really hard game, reaffirming his personal commitment and the central bank's commitment to bring inflation to target 2%. However, they had two meetings now, and while he talks a good game, he hasn't done anything about it. He has not even voted in favor of a rate hike. And so the markets then are sort of like my friends from Missouri, the show me state. They don't want just to talk, they want to see some action. And what's happened with the Federal Reserve not acting, despite the good talk, is that the US yield curve has steepened. That is the difference between the short-term yield, like the 2-year yield, and the 10-year yield. We're steepening, and that is a sign, I think, of the market's lack of confidence that the Federal Reserve is going to act in a timely way and is going to act aggressively enough to push inflation back down. And so as we get ready for our September FOMC meeting, the market, after the soft jobs data and what I think is going to be that is a slight decline in the year-over-year CPI readings, the market is just less than a 50% chance of a September hike. Remember at the most recent meeting, 3 Federal Reserve officials dissented in favor of a hike immediately. I'm not sure that they were able to convince their colleagues to join them to cast a majority for this September rate hike. So I think that we really have to look beyond that. And that's really another point I'd make about how to think about the Federal Reserve. Chair Warsh is not a big fan of the summary of economic projections, the so-called dot plot, which of course has had its critics, but they don't have an idea of what to really replace it with. At his first meeting in June, Chair Warsh didn't even participate in the summary of economic projections exercise. He didn't submit his own views. So if I was, the idea is trying to think about how would he approach the issue, and I think that if one wants to separate and sort of downgrade the importance of the summary of economic projections, it is not to tie it to a rate hike decision. So I'd be leaning more towards an October rate hike than a September rate hike, and that would achieve part of the new chair's goals, and have to downgrade the stop plot.
Very interesting take. I think personally the introduction and the in progress work that his task forces are doing affect that timing as well from my standpoint, thinking that especially with task forces like communication and like data, there may be a little bit more of a pause in the action as they're still trying to reassess what their overall stance and positioning is from an internal structure standpoint.
That's a good point. I think, for me, I'd say Governor Waller, who was thought to be a candidate to be the chair, I thought he was his comments were very revealing about these task forces. It sounds very objective and scientific. Appoint these people, let them investigate back into first principles, and they'll come out with their best views. However, it's I begin off the assumption that he's putting people who are very experienced on a task force. Sounds like a good idea, yes, but these people have already preconceived views. And so I think Governor Waller said, if you tell him who's on the committees, who's on these task forces, he'll tell you what the outcome is. So it's one of these things I think where, which I find happens oftentimes with policymakers. They reach a decision, and then they give you the logic, and that logic comes after they've made that decision. And so I think that what we're going to find is that the task forces want to think just purely about the communication. They want the Federal Reserve to communicate less. And in fact, Chair Warsh has even suggested reducing the number of meetings the Federal Reserve has. Right now, it has a meeting 8 a year, and he's talking about reducing that. The statute, the law requires at least 4 meetings. I think it's a mistake to reduce the number of meetings. I think it reduces the chances of reacting in a timely fashion. And I think that it really is an exception to what central banks have done. I think that in the recent decade or so, I think especially since the great financial crisis, and then again since COVID, that the thrust has been that central banks have an incredible amount of power. And in order for that power to be held accountable, they need to be more transparent and have more meetings. Um, back in the, I want to say it was in the 90s, that there was a book written by a former Rolling Stone reporter, William Grider. He wrote a book called Secrets of the Temple. Secrets of the Temple were all about the lack of transparency of the Federal Reserve. It was like a temple. When I first began my career, the Federal Reserve wouldn't even announce the outcome of their decisions. The market had to interpret it from different figures that the central bank would report. So I think that the evolution has been in one direction as the central banks around the world have become more professional, as their power has become more visible, and that has become more transparent, have more communications. And I think that true to this Trump administration, Kevin Warsh is trying to push it back against that tide that we've seen in the last 10 years, 20 years.
Interesting perspective, great insights there. Let's jump around a little bit and let's talk about what the labor market picture means for interest rates and bond yields.
Sure. So, like I say, the labor market was seeing some mixed signals. It's very interesting. A lot of times when I'm speaking to clients, of course, the subject of AI comes up. And while it does seem that AI especially in the tech sector and in finance, has seen some job losses. There's other evidence that AI is creating different types of jobs. And that's what we see with technology often, right? Is that we lose some jobs and we gain other jobs, other sectors. And it's really about making that transition as frictionless as possible. But I think that the other issue here is productivity. And this is where the Federal Reserve is, especially Kevin Warsh, is a big believer that the AI sort of revolution, if you will, is going to do the same thing that the internet revolution did. And that is, it might be slow to show up in the data initially, but it's going to lead to higher productivity and which helps lower price pressures. I think that is really the sort of the establishment view. And I think that it's going to have to be tested, of course, as time progresses. But I think that the labor market so far, I'd say generally in the U.S. is holding up well, and that we're still in that kind of situation. I think that Powell called it low hiring and low firing.
That's a great initial thought for really how should investors think about the balance between economic resilience and policy uncertainty currently occurring.
Yeah, it's a tough one. I think this is really where it's not really much of a science. I think that's really an art, and it's really a question of, I think, for a lot of our clients, uh, and even ourselves, I think we need to trust. We need to have financial advisors. We need to have trusted advisors that we can go to during these times where things seem to be in turmoil or chaotic and a lot of uncertainty. And I think this is part of what the investment climate we should expect it to remain. And it is high degrees of uncertainty. Partly, policy seems to be very much in flux. We thought that for a while, people were talking about the China shock. The first China shock was as China moved into sort of labor intensive, low value added manufacturing, toys, furniture, clothing. But now we've got the China shock 2.0, which is the Chinese moving into higher value added electronics, automobiles, robotics. But what I think for most of our clients in the United States, that the real shocks are coming from the United States right now. China is a big deal for sure, but it's really on the outskirts of where most of our clients are sort of live and breathe. And for them, I think the two shocks are really emanating from the United States. One is the tariffs that began last year. We're not done with them yet. We're still putting on more export controls. We have more tariffs coming. Uh, and I think that this is leading to some great uncertainty about policy. Those first set of tariffs that President Trump imposed, which were found illegal by the Constitution, actually by the Supreme Court, saying they were unconstitutional. The government already has paid back $100 billion in those tariffs that they previously collected, which is adding to, of course, the budget deficit this year as it shrank it last year. I think uh, that the other shock, second shock from the United States, of course, is the war in Iran. It seemed to be a war of choice. It seems to be a very disruptive, not only of energy, but of other things that come from energy, including the natural gas, the pesticides, the fertilizers we've talked about, and also some other industrial materials that are used for semiconductor manufacturing. So I think that the shock of higher oil prices, higher energy prices, and the tariffs keep our U.S. clients sort of on a very uneasy situation, unbalanced, and unsure about the broad direction.
Right, volatility's shifted in some of the areas that we've seen from the last few years, but it's been seeming to be a constant for a few years in some sort of area where we're seeing this drastic volatility. Now shifting, let's talk a little bit. You had alluded to Kevin Warsh being committed to that 2% inflation rate and that the Fed will confidently deliver on that. So, how confident should we be that inflation will move toward that Fed target? And maybe some of this has been already alluded to in this podcast, but what could disrupt that progress that again has been stretched out from what the timeline previously was?
I think as prudent business people, we should assume that there's very little progress on inflation this year. what's happening in energy prices, well, we're back up now. So that means that there's going to be little relief for gasoline. And like I mentioned with the weather and those related issues, we should expect firm food prices, and we should expect more tariffs. So I think that we're going to see inflation, even if inflation is peaked, we're probably not going to reach that 2% inflation target anytime soon. I think it really requires then businesses to think about pricing, to think about inventory management. But I think that's the prudent thing to do is to assume that officials are not going to be able to achieve that bring down inflation back to that 2% area. We've overshot it for many years now. And I think that every meeting that the Federal Reserve waits to raise interest rates pushes inflation further away from our goals. Even if in the short run it slips a little bit like we expect, inflation is not going to get back to that 2% target, and we should anticipate that as business people. Like I say, oftentimes in a high price pressure situation, businesses want to accumulate inventories. They have to be checking on prices to stay competitive. And I think that that's really the thrust of this is that I think that inflation stays high. Where we get whatever we give back on energy, we'll pay again in food prices.
Great. I want you to now get out your crystal ball because what is the biggest risk to the economic outlook for the second half of 2026?
Yeah, I think the conventional wisdom is to find fault with other countries. China dumps their goods in the U.S. Russia does something in Ukraine. But I think that we are our own worst enemies. It's the U.S. policy, the lack of transparency on Fed policy. It's the tariffs by the federal government. Uh, I just think that the volatility, and the lack of transparency of the administration's policies, monetary policy, fiscal policy, is makes it for a very uncertain environment. I think there's headwinds, but again, I think that the U.S. consumer has been very resilient. Partly, again, this is wages, which help fuel consumption, as well as a fairly resilient labor market so far, and the AI build out. I think this is what makes it really difficult for economists, including myself, to make sense of what's going on. It's not so much just the K recovery, but it's this big divergence that we have in income and wealth in the United States, where I think that the top 20% of income households account for about 40% of U.S. consumption. That's the same ratio as the bottom 60% of the household incomes. And so what this means is that even though, say, consumer confidence has been hit hard because the consumption is concentrated so much in the high income households, it's really, I think, allowing the U.S. economy to perform better than what these surveys would suggest based on how people's attitudes, their job insecurity, income levels, which still are not really fully keeping pace with inflation. So to me, this is the real headwinds that are coming for us. And it's really whether we can offset them with other things like the AI build out or how long American households are willing to go into savings to fuel current consumption. So I think that we should anticipate there's still a high degree of unknown, and I don't think that getting past the midterm election is going to solve that for us. I think the uncertainties are going to linger much longer.
Right, I agree. And we heard Kevin Warsh say 63 straight months above benchmark, 64 straight months above benchmark now in a row on inflation. But let's talk about how trade, fiscal policy, or geopolitical risks are playing a larger role in the outlook compared to a normal year that we really haven't seen for a little while at this point.
Yeah, and I think that that normal period is gone. I think that there's a Ian Bremmer who runs this group called Eurasia Group. It's sort of a think tank, mostly politics, a bit of economics, and he wrote a book several years ago called The G0 World. And what that was supposed to capture was the idea that there's no one who's making the rules of the game and defending them. And it's sort of like political scientists call it the hegemonic stability crisis. Capitalism works best when there's a one country that's strong enough to set the rules of the game and enforce them. And we're seeing that loss now, and I think that makes for a very volatile geopolitics. I mean, since the beginning of last year, 2025, the U.S. has bombed 7 countries at least, and I cannot imagine what the American media or what us people would think if any other country did that. We're so worried about China invading Taiwan, and yet it has not bombed a single country, while we've bombed seven. And not only did we go into Venezuela and kidnap their leader, but we've also had a decapitation strike against Iran. This is just it's like mind blowing that we're doing this with very little pushback on the world stage. Geopolitics, it remains a mess. It remains disorderly. Russia and Ukraine are still fighting. I think that the tide might have turned a little bit. Ukraine is the sophistication of Ukraine drones, both defense and offense, are very important. And now the Iranians are trying to learn from that just as much as we are. And so these wars, both the Ukraine and Russia, as well as the U.S. and Iran, I think we're really seeing a new generation, sort of modern warfare, and the role of these drones and the importance of intelligence. The geopolitics, I think, remain fluid for a while. I don't see how either conflict ends in the near term. And I think that the administration's tariffs also destabilize the world. For me, perhaps the most interesting thing with the tariffs is how few countries have retaliated. Many countries and many companies are sort of willing to suck it up, thinking that they can outlast the Trump administration. I worry about that because the revenues that we're getting from the tariffs help reduce the U.S. budget deficit. I can't imagine that whoever is elected in 2028 will cut that funding off, will deny themselves billions of dollars of revenue. And the same thing goes for the power that's being concentrated in the presidency now. I can't imagine that after the 2028 election, whoever gets elected is going to say, we have too much power in the presidency. I'm going to give some back. I think it has to be taken back by Congress, and I'm still not sure that we'll see what happens in the midterm, but I'm not sure that they will have the stomach to do that. So I am worried that we're entering a period, an extended period, geopolitical uncertainty, uncertainty from the U.S. policy. What is its commitment to free trade? What is its commitment to our allies? And then, of course, we have the separate issue of the new Federal Reserve chair, which in the past, new Federal Reserve chairs typically get tested, and the stock market tends not to like it.
Right, which we're really not seeing here, but interesting points. I agree that we're going to see, again, another point of volatility for an extended amount of time. Thank you also there for a new book to add to the reading list as well. So, as we keep thinking about all these things we've discussed so far today, which key data points should people, especially business owners, most heavily track to understand where the economy is headed in as real time as they could possibly track?
Yeah, it's funny. I think this is exactly what one of Warsh's task forces are going to try to ferret out. But I think ahead of those task force decisions or judgments, I think there's two little reports that matter for the markets, and that's the jobs market and inflation. And I think that as long as we see the U.S. jobs market hold in fairly well, I think that the Federal Reserve is going to be biased towards raising interest rates. At the June FOMC meeting, 9 of the 18 members that cast votes, that is again, Warsh did not vote, or did not cast his dot, should say, that 9 out of the 18 that did thought a rate hike this year would be appropriate. Uh, about half of them, or two-thirds of them, thought that at least two hikes would be necessary. So I think that as we think about, we're already about halfway through Q3. So as we think about how the year winds down, I think that we should be anticipating at least one Fed rate hike. We should be watching the jobs market, and Powell, I think, had it right that when it comes to inflation, there's one measure that matters. It's CPI, perhaps you'd say the PCE deflator. But when it comes to the labor market, it's multidimensional. And I think that we're still seeing that slow jobs growth, net net. We're seeing wage growth slow, but still the resilience. And that's why I speak of the weekly jobless claims. That's the closest thing we have to a real time read on the US labor market. And that sub 200,000 on the 4-week moving average is notable. So I think that on balance, the Federal Reserve still is going to be itching towards a rate hike, at least one this year.
All right, so we just talked about interest rates. How about your base case for forecast on some of those other areas? So GDP growth, inflation, unemployment. How are you feeling that those will end up through the end of 2026 and getting into 2027.
Well, I think that's where that dichotomy between the GDP and that final sales to private domestic parties. So I could see how the that final sales to private domestic parties softens, even if GDP holds up. You know, when you think about the GDP, remember that what the Federal Reserve says is trend growth. That's the non-inflationary pace of growth is around 1.7%. So on balance, it still looks like the U.S. economy is growing a bit above trend. That's good for us as businesses, but it also means that harder to get price pressures under control. I also think that the unemployment rate probably is going to tick up a bit more. As I mentioned, we ticked down, and that's due to the participation rate. And I think that part of this might be some seasonal quirks related to school teachers and the education cycle. But I think that the economy, I think in the big picture, the economy will be slowing, unemployment rate will be rising, and the Federal Reserve is going to end up to be in a pro-cyclical fashion, tightening rates as the economy slows. So I think for many of us business people, it's still going to be a very challenging second half of this year, and as the year winds down into early 2027.
Thank you so much for your time. It's always a pleasure having you here, Mark. I know I learned a lot today. I'm sure our listeners did too. I'm excited that we'll see you back here in a few months as well to discuss the results of the midterm elections. And then, of course, going over your new book coming out, Surplus, that comes out later this year. I know, again, I'll have another read to add to my reading list there. So, again, Surplus, The History of Too Much and the End of Economic Primacy. That releases November 3rd, and it's available for pre-order now. Again, thank you so much for your time, Mark. It's always a pleasure.
Matt, and good luck, everybody.
Appreciate it. And thank you all for listening to On Point, a podcast by Oak Street Funding. Again, I'm Matt Staninger, and tune in next time when we sit down with Rob Medor, director at Marshberry, to discuss the current state of mergers and acquisitions in the RIA industry. Don't forget to rate and review on Spotify, like and subscribe on YouTube, and follow us on Instagram for more insights and behind-the-scenes content at onpoint.with.osf. See you next time.